We are a distribution partner for Jamieson Coupe Bonds. Jamieson Coupe Bonds is a specialist in managing local, global and absolute return high-grade bond portfolios. And today it's my pleasure to introduce Giselle Roux, Mark Burgess and Charlie Jamieson. And they're going to be sharing their thoughts on the macroeconomic environment, markets and asset allocation as we head into the second half of 2022. I'm going to share a brief background on our speakers today. So Giselle Roux is a former Chief Investment Officer at Scala Partners at JB Weir. Giselle also participates in investment forums and is a regular contributor to the AFR. Mark is a former CEO of the Future Fund and is the current chairman of the Investment Committee and board member of HESTA. Mark is also the chairman of the JCB Advisory Board, and Mark has extensive global career leading both asset managers and asset owners. And to my left is Charlie Jamieson, a co-founder of Jamieson Coupe Bonds and oversees portfolio management for the Australian, global and absolute return high-grade bond investment strategies. Charlie forged his career as a seasoned bond investor from 2001 in New York, taking him to Tokyo, London, Sydney with Merrill Lynch, Bank of America, and has managed money through a number of market events. So today's kind of session is going to be me asking the panel a number of questions. We will have Q&A at the end. As I said, please feel free to grab food and drink throughout, and hopefully this can be just a bit of a, I guess a series of questions and evolving discussion. So Charlie, I might start with you today. One word's inflation. Had a pretty big print today at 2:30, so it'd be really good to kind of get your views on inflation, the impact on portfolios and especially bond allocations as well.
Well, it's clearly the topic of the year and what central bankers are trying to push back on now. It was always going to come as a result of very generous fiscal and monetary settings. And staying in those settings for too long, huge demand for physical goods when services couldn't really be consumed, and so that was essentially what we were experiencing at the end of last year. But it's just cannoned straight into the Russian-Ukraine war, which has now added global energy and food inflation to the system, and then on the back of that, Chinese lockdowns, which thankfully look like they're starting to moderate a little bit. I saw that Shanghai today was at 95% capacity in terms of its port utilisations. So it really has elevated inflations around the world, particularly in Europe and the United States. And central bankers have told us that they will continue pushing, using a very blunt instrument of monetary policy to try and temper demand, to take take demand away from those supply side issues and try to moderate inflation. And it looks like they will have to push very hard to do so. So we're going through an incredibly dramatic series of tightenings in a very short space of time. It's combined with also the changing kind of fiscal settings. We're not enjoying those huge fiscal spending programs that I guess we all enjoyed collectively throughout the COVID period. And a lot of the policy crutches that markets have been elevated on, being that fiscal, that monetary, the quantitative easing and the excess liquidity, have been thrown into violent reversal. For fixed income allocations, it's been tremendously difficult. Bonds are having their worst year by a factor of since the big sell-off of 1994, and in some instances, the worst ever by quite some margin. US indices, down around 10%. Australian indices similar. Credit markets more again, and that's really without any kind of crescendo moment, I guess. And we do expect that there can be a crescendo moment because we're raising these risk-free rates very, very rapidly. And so for portfolios, it's been bonds that have led that underperformance. I think yourselves as sales folk would attest to lots of upset fixed income investors earlier in the year. And once that volatility skips into other asset classes, people stop ringing about fixed income and start ringing for a totally new reason, which is, gee, that's actually sold off quite a bit. Maybe I might rebuild some defence. So it's been very tough. Obviously, the inflation situation, which is really complex, has been generating positive correlation in many asset markets, and that's made the natural defence of bonds that's worked very well in that negative correlated kind of setting more difficult. What we tend to find is that until we get above 3%, which we are right now in US Treasury yields, we start to get a bit more of a normalisation, and you get that flight to quality movement, or that movement into safety, as people become concerned about the health of other parts of their portfolio. So I think it's a really interesting time to be talking about this. We certainly won't have a big product push about what we do for the purposes of this conversation, other than to say we've been through the ringer pretty hard in the last 6 months, and I think there are some dots that we can join to other parts of the portfolio to hopefully make you think about the right questions to be considering. There's no finite playbook in all of this. If there's regime change and the war finishes in Russia, we could have a booming bull market for the rest of the year. We're not entirely set as to the outcomes. Of course, there are tail risks both ways. But if we stay on this pathway, then we will have 2% Federal Reserve overnight cash rates in July, in about 6 weeks' time. And that is quickly approaching 2.5%, which was the level at which credit markets couldn't make it past without having problems in 2018. And I think that's important thinking about, because in 2018 the world was very stable and fairly peaceful, and obviously it was much easier to forecast with a tighter degree of certainty. We don't enjoy that at the moment, and we're getting right up to those levels that have caused us issues previously. So I do think that is also worth thinking through in terms of the asset allocation and the way markets can respond, not necessarily the way economies will respond, but just markets being markets. They can move very quickly and not always the way you'd think they will.
Yep, great points. And Giselle, I might just pivot there to you and Charlie talking about other asset classes, but what are professional investors diversifying in their kind of fixed income exposures? What other areas can they look to play?
Well, I think many in the room would be more than familiar with what's been transpiring, which is a massive flight into private credit, and the story is well told over and over again about disintermediation of the banking sector and the fact that Australia is relatively weakly presented in private credit. So that's been the go-to sector for yield. It'll be interesting to see how that part of the market responds to somewhat weaker economic conditions and perhaps some problems in the property sector when it comes to the cost environment and the developer market there. But everybody can suppose that something might happen there, but while the yields on offer have been so attractive. So it's really been a yield-driven market looking for, perhaps you can argue, irrationally high returns purely out of that kind of fixed income, at the expense of a defensive mindset, if you like, to fixed income style portfolios. You don't, strictly speaking, call those fixed income. So it's been yield, yield, yield. Quality has been modest, and the idea of a capital gains from spread contraction and so on has really dissipated, because there's been, quite frankly, not enough evidence that is sustainable in the current environment.
Okay, thanks. And then Mark, I guess just picking up what Giselle said, there are those risks in the yield market, but where else are we seeing risks in asset markets going forward?
Excuse the cough. Look, I think the most important thing to remember is what we went through over the last 2 or 3 years. I often say that central banks have become very, very skilled at crisis. And in fact, they're so skilled at it that at Jackson Hole in 2019, which is around, August or thereabouts, they were presenting papers about what to do in the next crisis. And the papers were all about the combination of fiscal, because they felt they didn't have low enough rates, plus monetary. They were kind of preparing themselves. So you get 2020 and they come at you with incredible stimulation, and we get 2 years of unbelievable returns. Let's face it. I mean, if you said to someone we're having a pandemic and we're about to get a great rate of return, you'd be amazed. In fact, I bump into people with money who are surprised by how rich they are. And this happens a lot. And so, but the fact is that all that stimulation, all that kind of push forward by central banks, pushed things to levels that needed to set back at some point, most likely. They also do a secondary effect, which is that when you get very low interest rates, you basically make capital for free. And when you get capital for free, you also get a response. And I have this chart I use on Netflix, right? Only because it's for one of an example. But Netflix, the stock goes through the roof. Everybody finds out that streaming is a great idea. Next thing you know, you've got 8 streaming services. But that multiplier of excess capacity has turned up in lots of places. There's more electric car manufacturers you can poke a stick at. There's lots of excess. And so you not only get the effect of the sudden estimation that interest rates might rise, the economy may slow, but you get sectors that have too much capacity in them. And that also applies to the investment market. So, is there too much capacity in VC in the short term? Are there too many startup companies which still need funding but haven't yet consolidated? Are there holdings in your portfolio? And this is a common problem institutions have had, where PE has performed so well it's become disproportionate to the rest of the fund. And so all you needed was a slight change in the monetary environment, and you've got to see some of that stuff correct. And it's been brutal in a number of areas, but not surprising given how well things had performed. The key to it is to have a medium-term strategy. The key to it is to advise, but looking forward, it's most likely, it seems to me, that rates have come to an area that make them attractive, back to an area at surprising speed. And secondly, the tailwind of falling rates, which has been prevalent for the last 40 years, is probably going to slow. We've always had the view that rates would trade in a band. That V we had where 10-year bonds in America went to 0.5% was sort of an accident of history. Now it's back in the range, non-is in the back in the range at the top of the range, and it makes yielding supportive, but what it also means is that you don't get the tailwind, so the easy gains aren't going to be there over the next couple of years. But for you guys as advisors, or for people as advisors, this is where you come into play. This is where you're able to pick a good manager or a good investment or a good portfolio construction. That's going to add the value looking forward, and I think it's kind of exciting but challenging in the short term as we deal with clients.
Well, I guess this is where our audience, I might look for some hands in the air, but we've just kind of, Giselle, Mark and Charlie, kind of thought of some questions to kind of pose to you just to kind of get a sense of where the room sits. But in terms of challenges, and just raise your hands, there's 3 options, but when you think about what are the greatest investment challenges for you as advisors and for asset allocators, could you a raise of hands for lower investment returns, if anyone has a feeling that lower investment returns are going to be a challenge going forward for their clients? Is there anyone? 1, 2, a handful, okay. And then the second one's rising rates. How much is that of a challenge for people's and clients' portfolios? A couple, okay. You can raise your hands, I'm not going to point at you, don't worry. And then achieving sufficient portfolio diversification. What Mark said is that, interest rates kind of, drove a lot of the returns. Is anyone worried about actually getting true diversification from portfolios? A couple, okay, great. And then Giselle, maybe you could share with us just what some of those alternatives to achieve returns could be like. What are you seeing out there in the market? You talk about private credit, but what else are advisors looking at?
Yeah. I think to me, one of the dilemmas one has as a privately advised portfolios is whether one can be tactical or have the foresight to actually both get in advance and then have the tolerance to accept that may not be exactly the right time as well. And, with hindsight, we can all look back at last year and going, I wish we had rotated into value and bought a commodity ETF. Now when we sit here, it seems somewhat blindingly obvious. So it's going to be that uncomfortable feeling of starting to invest in something that feels as though it's likely to emerge, but at the moment, no one really wants to almost, where you almost have that whole saying of investing when you feel uncomfortable, to me sounds about right now. Because I still go, well, what are your real options? Do you pour more money into value stocks? Probably not at this stage if you've missed part of that rally. Do you try and pick through the entrails of your growth companies? Well, that seems, the Netflix commentary and many others would suggest that that's going to be a much more challenging environment. So you start to eliminate a lot of these potential ones. And I think the question that I often ask people is, what is the return where you would be comfortable in fixed income? Now focusing on fixed income because that's what we're talking about today. Is a 4% return adequate? Is that something where your client would say, a 4% return, I'm happy to allocate 5 or whatever percent of my portfolio to something like that? Or are they become so accustomed to the higher returns that they have these perceptions that only 6 or 7 is going to be sufficiently interesting, or I'll wait until something else happens? And I think that's, as we go into the new financial year and people get their distributions, if there are any this year, and start to rethink about their portfolio resets, I think that's going to be almost the most important question to ask them.
Okay. And then Charlie, I guess, what we're experiencing today in the bond market, Are you expecting to kind of see a reversal of the violence that we've seen?
I think we are. I mean, we had a surprise raise of 50 basis points today from the RBA. The markets were set up for either a 25 or a 40. There were a couple of commentators that were expecting 50. But the totality of the sell-off that we had as that surprise was delivered was a lot smaller than other days in the sell-off where nothing's happened. It's just sold off because it wanted to go to that place. So that's a good kind of sign that we're starting to get to that exhaustive point where maybe there isn't a big push from the momentum players and the like. I think the terminal rate assumptions that we have now are very, very elevated. I told you today that the expectation from the market is that the RBA cash rate will be at 3.6 or 3.7% in 1 year's time. Probably a few people shift in their seat a little bit and think that will be quite an uncomfortable economy thereafter. And certainly we know through the property channel and the construction channel and who will build into forward delivery that looks challenged, those types of things all come up very quickly. So I think we started to see that. In May we saw some negative correlation from the bond market, which we haven't seen for a while. But what's really happening in here is that because of the risk rally that we'd experienced after the 7-week sell-off, financial conditions eased again, and they really need to tighten. And the central bankers have been very explicit about this point. They want you to stop spending money. They want to take away your wealth so that you take pressure off frustrated supply lines and the demand comes down. And until that happens, they're going to keep hiking. And so Chairman Powell said he's going to keep pushing until this occurs. Now that is not a good thing because we've had these kind of comments in the past. We had them in 2018 where he said we're a long way from neutral and likely to exceed it. That was in October of 2018. It caused a bond market sell-off, which caused a seizure.
Freezer. Okay, that's a new word. Okay, coin that.
Of the corporate credit markets, particularly in the high yield markets. Now, we're not talking about a new idea like looking to raise fresh capital. We're talking about existing debt that needs to be rolled forward and on quite short maturity time frames. And that really is the financial oil that plumbs the entire financial machine. And if that becomes blocked, then it can become very chaotic through the industry. I guess we saw this very famously at the start of 2020 for different reasons because of the COVID lockdowns. But at the end of 2018, that really caused a material equity pullback late in the year, probably a little bit liquidity affected because of low risk appetite and the like. But that caused a pivot from the Federal Reserve. And it's that pivot point which has been the safety net which everyone's been able to invest into. I think this time around that safety net is a lot further down because if we get to that point, and as I said, it was at 2.5% Fed funds last time around, we will be at 2% Fed funds in July. If this occurs in the second half of this year at some time, inflation is still going to be at 5, coming from 8. You can't cut rates and do QE if inflation is 300 basis points above your mandated level. And as much as average inflation targeting allows for more flexibility, it's just not going to be politically viable. So I think that's something that we've got to think through, and that's why I think, we are getting closer to that point. Obviously, inflation is transitioning from goods inflation to services inflation, which tends to be very sticky. But if you follow the Walmarts and Target results and these types of folks, you're starting to see that inventory cycle is built very quickly, and what has been deficit has gone to surplus. And we are starting to meet some of these challenges that were built up over 2021. And we've written a little bit about that. It's called the bullwhip effect, and it can happen very, very quickly. So we can have a period, and as I said, with all of these exogenous inflation shocks, if we get more of them, of course, then everything's off the table. But otherwise, inflation should moderate to around about 4, and asset markets in general will like that. It means we don't have as much to do, and bonds inside of that will like that as part of that whole story.
And then I know you've talked about this previously, but the speed and the cycles that we're in, do you kind of see that people need to think about this quickly, or it's going to play out over the course of the next few months?
So just to put this in context, in 2004 to 2006, it was until the 15th interest rate hike that the bond curve inverted. We all know that inversion of the curve is a precursor to the recession. 15 hikes in, we get the inversion. In the cycle from 15 to 18, it was a slow cycle. I think it was the 7th rate hike where we finally had the bond curve inversion. In this cycle, we inverted 13 days after the first hike. So to say we're moving very quickly here is a real understatement. This is incredibly fast cycles, algorithmically driven, lots of computer interaction, lots of seek and destroy in markets. And so this is what we worry about, and we've spoken a lot about market fragility in these moments, and we've seen them, just the way that they can cascade in early 2020, and we needed the kitchen sink to restabilise that. We can't deliver the kitchen sink again if we have that moment. So I think it's a bit of a binary setup. You either get set ahead of time, as Giselle was saying, it might feel a bit wrong, and then it might feel incredibly right very quickly, or it might not happen. It's all out there and possible, but definitely things are moving fast.
Okay. And then Mark, have you got any kind of further thoughts or comments?
Yeah, look, I think as Charlie said, the most interesting thing is that the bond market sold off so dramatically. It's almost like the bonds were in some sort of artificial universe where, yes, the 60-40 wasn't going to work down there, not by a long shot. On the other hand, we also had the benefit of that, which is, as I alluded to before, which was that, and no one ever talks about this, and you see this in institutional investors, right? When you're on an investment committee, everyone loves big performance numbers, right? But no one ever goes, gee, everything's correlated. I mean, that's as frightening on the way up, although it's a positive return, as trying to find anti-correlation to protect yourself. But out of nowhere, the bond markets got reset to be a defensive asset, just like that. And that's remarkable, and it's partially, I think, because A, the markets are efficient, they kind of can smell it, and B, the central banks are asleep. As I sort of alluded to before, central banks have become fantastic at crisis, but they're just really average at coming out the other side. And if I gave them one piece of advice, I'd say you've got to learn how to manage that. And so, for example, instead of cutting rates to zero, what they should have done is said at 75 basis points, we're going to cut to zero for 6 months. As an emergency measure, we're going back to 75. Just have a rule. But the market noticed that they were doing nothing, so the market reset. And for us as asset allocators, it does mean we've now got a new defensive asset, arguably. Now, you're at a Jamieson Coop Bonds event, so what else would you say, right? But if you look at the chart, it's at the top of the range of what we thought would be a long-term range for bonds. What hasn't said on the other side, we don't really know yet. Some risk assets have corrected. And the real test will be, and I think Charlie's alluding to this, is that is the plumbing going to get frozen up that causes a real fright? I'm struck by how many retail investors haven't got out, including my kids who loaded up on equities in this cycle, and I don't know what they're doing with their equities now, but they still haven't figured that out. So there's some unresolved issues in risk assets, but the bond market got reset as a defensive asset at a time when, frankly, a year ago, it was extremely hard to describe what a defensive asset could be in a portfolio, including the $8 wasn't necessarily going to be defensive. But now it has. So I think that's the takeaway recently, but the flip side of it is, is your portfolio kind of well structured? Has it got out of alignment? And then you've got this second thing, as I sort of said before, which is the real value add looking forward will be, after 40 years of rates lifting every boat, the future will be 80% of the return will be the asset you own or the quality of the fund manager. It won't be that every fund manager is great. I joke that every infrastructure manager thinks they're terrific, right? I mean, that can't be true. And so there'll be mistakes in portfolios and things like that. So the real art will be both the way you construct the portfolio and then how you select each part of it. But at least there's now some defensive assets that are available.
Well, this is a great segue to the audience again. Just a show of hands, just to looking at, this is more for Charlie to yell at me later on, but active versus passive. Who in the room in their defensive part of the portfolio, bond allocation, would use 100% active with their allocation? Done my job, so there you go. And then who's probably at zero, or who's just using completely index-aware strategies for fixed income? Anyone? There has to be one. Okay, we've done our job, so that's good. And then Giselle, I guess, your comments about what you're seeing with clients, and are they talking about looking to add duration into portfolios, or that's just not in their wheelhouse yet?
It is, I might even throw that question to Charlie and to some extent Mark, but one of the problems with duration, the curve is so flat that you kind of go, well, am I really adding duration, or am I just adding a nominal rate almost because of the flatness of the curve? And that, that's from a private investor's point of view quite unhelpful, because it means you can't really talk to making money through the roll if you've got that kind of curve. So I think there's some challenges for fixed income management that where the positioning and how the returns will be achieved will need to be somewhat clearer before one's really willing to put one's anchor into that.
Yeah, I spoke at the Morningstar conference last week. A few of you, I think, attended virtually. And the feeling there was that it was time to lean into it a little bit. That wasn't, I'm all in by any means, but certainly the yields are back to levels. In fact, it's the yieldiest environment we've ever had as a manager. I think, if the portfolio stands still, it has a roll and carry return of about 3.8% at the moment, with just as an index. So we're getting up to those levels which are becoming, more digestible, certainly than where we were previously at, 1 or thereabouts, was pretty difficult. And of course, the modified durations have fallen in that process as well. So they really are, have the ability to rally if we were to have a big growth shock, or for however we were to find a deflationary environment because asset bubbles burst or whatever that might be, then the long end can do very well. And arguably, the curve would become potentially deeply inverted, and we've certainly seen that previously. So there is still some steepness, but I guess that, in Australia, and it's worth talking about this because Australian interest rates are so much higher than some of their global peers. We are now pricing a situation where we out-hike the Federal Reserve by about 60 or 70 basis points. That's quite an extraordinary thing, given that we have a much lower inflation setting. We have our own energy ecosystem, which we can hopefully politically gain control of again. We don't have this kind of wages issue in the same way that the US system has. The US obviously fired everybody in COVID, and then there was a tremendous race to rehire talent as things opened. JobKeeper obviously didn't mean that happened here, but there's no question that wages are moving higher. But the transmission mechanisms that we have here are so much more acute with regard to the movement of central bank policy. So about 80% of mortgages here will instantaneously tonight move higher in terms of their funding costs. In the United States, that's only about 15%. So a tremendous difference. Most of those those mortgages are calibrated on a 30-year fixed mortgage rate. So if you were lucky enough to fix it 3 and the rates now move to 5, well, who cares? They've got 30 years to work it out. In Australia, that's and it's going to be instantaneous. And so the move today, it was unexpected. I think it changes the journey, but not really the destination, in that we are very indebted here. There is a point at which we struggle with what's called escape velocity. So we're starting from a position of rude health. Where else would you want to be in a troubled world than all the way down here in Australia? The tyranny of distance is actually a wonderful thing when the world's unstable. We have everything we kind of need. As long as the sun would come out and get a little bit warmer here, we'd be absolutely happy, unless you're a snowstorm. But the point is that this will be very impactful in the way that it will feed through to the consumer. They're already facing high energy costs, high fuel costs and the like. The rate of change of inflation is very likely to come down quite quickly, and I use this example all year. If you think about energy, oil going from 40 to 80, 100% inflationary, oil from 80 to 120, 50% inflationary, oil from 120 to 120, 0% inflationary. Now that's still very expensive on Saturday morning to fill up your car, very, very expensive. But the rate of inflation as the markets actually calculate it falls away dramatically. And so we are starting to see, I guess, that crest. If we have a China-Taiwan moment or something else drops right at the perfectly wrong time, well then of course inflation can remain elevated. But otherwise it should moderate, and that's a good thing.
Yep, I agree. And then I guess the last question for the panel, and then we'll throw to questions, is the R word, recession. Where, Giselle, do you think we are? Do you think they'll be able to navigate a soft landing, or where do you sit on that kind of question?
Yeah. Look, I'm not going to necessarily claim that I can make a forecast, but I mean, the whole terminology recession is a bit fraught. The idea of just 2 quarters of negative GDP doesn't necessarily tell the full story. You can have a consumption recession or domestic demand recession, and because our exports are so strong, we don't print recessions. We've had actually quite a number of those in our so-called non-recessionary period that we had. If you're going to say there might be 2 quarters of domestic demand retracing, I wouldn't be surprised to see that, quite honestly.
Okay.
So you can call it a recession in that sense. Iron ore pricing doesn't affect Mrs. Mortgage.
No, exactly. And then Mark?
Yeah, exactly right, a recession. So I think the real question is, what sort of bear market is it? Is it a moderate bear market, or is it a really bone-chilling bear market? And for a bone-chilling bear market in risk assets, you've probably got to get a dislocation with leverage involved in it. And you've usually got to have leadership of some kind. So the housing market with the overlay of derivatives, which doesn't get talked about much in 08, was massive. It was a massive shock.
Yep.
72 was a massive shock, 82 was a... So where are the dislocations and how much damage has to be done? I'm hopeful that it's a little more micro. It's inside your growth portfolio. Sadly, if you've been very overweight, because that stuff was just absurdly priced. It's probably in crypto, perhaps, although I'm old, so you allow for that factor. When I add it all up, I'm not seeing enough that causes a serious, really serious setback. But it is tricky because I fear that people are kind of thinking bearish but not yet positioned. And I do wonder, the retail market got back into this market at speed in 2020 because they learnt from 08. And there's a bit of resolution still to be had. So we're going to get some volatility, that's the bottom line. Yeah.
And Charlie, you always say it feels like they're going to raise rates and break some things. So where do you kind of sit on?
Yeah, it's traditionally what happens, but I think what's important to recognise is that since the GFC, the game's changed a lot. So when we all started our careers up here, and a few in the crowd, we would train to read the economy and then reflect that in the market pricing. After the GFC, the central bankers decided that the economy wasn't going fast enough. If we can pump the markets up, or maybe we can drag the economy higher as a result. And that actually worked pretty well. I mean, don't forget the economic scarring of the GFC. It took a long time to get going again. But the markets haven't really reflected the economy in the same way that they used to. It's been very manipulated. We've had bouts of quantitative easing and liquidity provision and all of these unusual kind of policies. So we can have bad market outcomes and an okay economy. That's certainly possible as rates normalise. We're really only talking about taking rates back in the first instance to where they were pre-COVID, and some of the froth that was interjected into the markets as a result of overstimulation, really coming out. I think it's a little arrogant of central bankers to think that they can engineer a soft landing. I worry that if they do go on this demand destruction route, it can be hard to flip the switch and get us all to go out for dinner and spend money again after we've forced ourselves to shut down because we simply can't afford it. I don't think it works quite as easily as that. So I do worry about that a little bit, but I think we are starting from a position of rude health. So as much as a lot of the trend that you're hearing about is now declining, it's starting from a really good spot. So you don't need to be too worried just yet. Clearly, if the trend evolves and starts to pick up pace, that is more of a concern. But for now, we're getting through and normalising accordingly. But I do think that the speed with which some of these things have reset do have a bit of a ripple effect through the system, and it does take a little time to turn up in other places. Like something like private credit, which has still probably got a beautiful linear series of returns and might not have been marked to market much. I mean, it's part of its blessing. It has very low volatility until it has some. So, but for now, it's like a duck sitting on a pond. It's very stable on the surface. There's a bit going on underneath.
Thank you, Charlie, Mark, Giselle, for your time today and tonight. And we'll see you again soon. Thank you.